Hello and welcome to Strategic Outsourcing 102. Today we're going to go a little bit more about the 80-20 rule and the cash flow statement. Two learning objectives. We're going to expand on the earlier topic on where the 80-20 should come from, and more importantly, how do we analyze 80-20 from the cash flow statement. I would highly recommend that you go through the Suzanne Croissant training videos on the cash flow statement because it provides a very good foundation for you to follow. The problem with revenue statement is because it is accrual by nature. I'm going to very quickly show you when does a company actually get cash from the customer. First, the customer needs to issue a purchase order. This is one step beyond the letter of award, where the customer actually says, Mr. Company, I want you to do task A and this is the purchase order for it. And then the company will deliver either a product or services or both to the customer, whereupon the customer needs to accept the goods received and rendered. That is why in outsourcing, a sign-off that you have rendered services is very, very important, because it is through this document that you invoice the customer. Now, only after the invoicing would an accounts receivable be generated if it is not a cash business. It means that the customer has an option to pay you later. The customer, upon invoicing, would have a payment terms, and the payment terms will state whether you need to furnish all the payments within an X period, typically within 14 days or 30 days, but sometimes it does drag on to up to 90 days or more, depending on the situation. For example, the customer could be arguing about the quality of work, or even after the service has been rendered, there will be bugs or issues with the system where the customer chooses to delay payment until the situation is solved. As mentioned, revenue is accrual by nature. The proper practice is to only capture revenue upon a purchase order from the customer, and this is where revenue entry is generated. But you don't even get the money until after invoicing, and even then there could be delays. On the flip side, a company will want to buy equipment from suppliers, and therefore the same pattern repeats itself, just that now it's from the other standpoint. So the company would send a purchase order for the raw materials required for the service. For example, you could be buying Microsoft software from Microsoft. And then the supplier would then deliver the product. Similarly, the company would provide acceptance or receipt of goods, which upon the suppliers would then invoice the company. If there are options to delay the payment, or rather the terms that state that you have to furnish the payments within 30 days or more, and this is where accounts payable entries are generated. So just to recap, there's three very important points here. First, purchase order is the point where revenue is captured. Invoicing is the point where accounts receivable is generated, especially for payments that are somewhat delayed. And towards the supplier, accounts payable is generated when there's payment terms for delayed payment on raw materials. How do you remember this? A company receives money from a customer, therefore it is called receivables. And a company pays the suppliers, therefore it is called accounts payable. We're going to use Mesiniaga's 2012 operating cash flow for the purpose of this lesson. An operating cash flow begins with profit after tax from the revenue statement. And cost has already been factored into the revenue statement to get a profit after tax. We're going to ignore the next section, which is adjustments, because typically these are non-cash adjustments. Non-cash means that within that financial year, there are no actual money that the company receives. Let's take one, for example, depreciation. When you buy a server, the value of the server depreciates, but you don't see that until you sell off the equipment. So while the sale of that equipment has not happened, the value has to depreciate. So it needs to be captured somewhere. This is where we're going to focus a little bit more deeper. Changes in working capital. Working capital is actual cash in hand. If you remember from the earlier lessons, there are three sections to a cash flow statement: the operating activities, financing activities, and investment activities. The key to identifying value comes from the operating activities, because this is where actual work is done for you to invoice the customer and get money in. Now, let us zoom in a little bit deeper. We've also included in this slide the financing activity, and you're going to know why I've done it in just a little bit. In this line item, we see receivables that Mr. has achieved for the financial year. Compared to 2011 to 2012, there's a marked increase in receivables. If you're wondering why the figure is negative, it is because although work is done, remember, receivable is where we have invoiced the customer, but unfortunately, the customer has not paid us within the financial year. Could be bad, it could be good. It really depends. And this is where the relationship is important. And you talk to the CFO, you talk to the delivery team to understand why is there a huge negative amount. In this case, it could be due to equipment that needs to be purchased first. And that's a lot of money, especially for a huge network-based or hardware-based business like Mr. where we need to buy a lot of stock up front before we can render services. So as far as receivable is concerned, although we've made a lot of business, we've not get the money yet from the customer. Secondly, our payables. Why payables are positive? On the flip side, we also kind of owe money. I wouldn't say owe, but it's really a payment terms that's been delayed. We have about 7.6 million ringgit worth of services and products that we already received, but we have yet to pay the customer. Hence, it is represented as positive. What is crucial is a large positive value of cash flow for the financial year. In this case, you see that Mr. in 2012 has a large negative value. When that happens, a company would typically need to take out borrowings. And these are normal for any business. Short-term borrowings are trade financing tools from a bank. And for example, it could be an overdraft. And when you put these two values together, or other products that does not require any collateral from a bank. So when you add all these values together, it's very important that the company has cash in hand, else it will be very difficult to pay salaries and to keep the project running. The basis to finding value from cash flow statement is very similar to activity-based costing. Every customer we treat as a project. We could be doing multiple projects, but what we really want to do is focus on the customers that give us 80% of our revenue. Remember, although we're talking about cash flow, but revenue is where actual kick-off of the activity, i.e. they've given us a letter award or a PO, and then we are supposed to do the job. But how do we immediately affect value? We need to find where the work is done. So each project will have project milestones, and each project milestone, once delivered, we can invoice the customer, and this becomes receivable. And the same rule also applies. Who exactly does the work to deliver the 80%? So we focus on that, determine the unit, and the key bit about strategic outsourcing is how do you use IT to help that unit within the business perform better, save more costs. Similarly, within an example like Mr. where pre-work activity requires a lot of upfront cash, the business unit will also have to borrow money before they can deliver activities to the business. So again, same questions you should ask yourself. How do you improve the situation such that you don't need to borrow so much money? How do you do just-in-time inventorying, for example? Now, the same unit that's delivering all the work will also be paying money to their suppliers, servers, licensing, and even services for subject matter experts that we do not have. And therefore, again, we focus on the 80%, and we focus on how does IT help to improve our payment terms, to improve our relationship with our suppliers, that to have a cascading effect throughout the value chain such that we can impact the business positively. The reason why we're looking at the cash flow statement for value is because we only get paid when a task is completed, i.e. through the receivables. And IT is at its best when it is able to improve operational processes. The fundamental issue that needs to be solved is that of a time lapse between winning the contract and getting paid for it. As this slide will illustrate, businesses that are new often assumes that we're going to get paid after the work is done, after we invoice, and then cash gets in the bank. Unfortunately, the reality of the situation is less sequential. Almost immediately after the letter of award has been issued to the company, a business needs to begin mobilization. They need to buy raw materials, start hiring people. On top of it, the customers expect the team to be on board even before the finalization of the contract. This leads to multiple issues. One of them being they can't pay you money without a contract. And usually for the chunky amounts, this will only happen after the contract has been finalized, which takes a longer time, which we will follow up with an invoice, and then there'll be a number of ping-pongs between the customer and the company because invoicing alone is insufficient, as it needs to be backed by a contract milestone as well as paperwork and proof that the task has been done. Again, I shall repeat that this is very important for the outsourcing business, that sign-off is attained by any activity that has been done for the customer in order for us to invoke invoicing and payment promptly. Without this, businesses will fail, and that also includes outsourcing business. And that's it. A very simple lesson on the 80-20 rule and how to discover value from it. And here's our exercise. Carry forward from the previous exercise about what is your business. Now determine the major receivables that you'll be getting from the customer. What are your key activities that generate money? Even if it's cash, it's not a problem, because the lesson here is for you to know how to uncover where value is coming from business. And value comes from sales. Value comes from being able to generate a reason for the customer to buy your products and services. Then put up some projected figures. How many products or services that you need to perform per month? Because these are the areas that you need to improve efficiency-wise. So you need to think further. Then determine how much effort that needs to be put in before you can do the sales. Because, I mean, just because you have a product doesn't mean that customers will come in and immediately buy your product or services. What are the sales activity? What are the advertising activities? These are also money. And then the key lesson here is how long before the first customer will come in. You can predict all that, you can project it. Then determine the payables. Who do you need to pay first to set up your shop? Where are the raw materials coming from? How long before the raw materials can arrive? And therefore put up the projected cost items, the payables for the cost items, and the other expenses as well as overhead. And determine how long before the supplier can furnish you all this product and for you to reconfigure the product to a point where it can be sold. Either you repackage it or you have to reconfigure it with added value items. The objective of this exercise is to train the ability to understand the business and not just being able to dream about your own business. Good luck.